Subscribe to my channel Report Stock.
Welcome to the Depth Dive. Today, we're jumping right into Caterpillar Inc.'s second quarter 2025 earnings.
That's right.
And this isn't just about, dry financial numbers. It's really a fascinating look at how a huge global company like CET navigates some pretty complex economic situations. We've got the sources right here.
Yep. And our mission really is to unpack all this, look at Key's performance, figure out what's driving these numbers, and, connect it to the bigger picture, industry trends, challenges. And a big part of this quarter's story, definitely, is the tariff headwinds. We'll be coming back to that.
Yeah, that seems key. And it brings us to the sort of puzzle, doesn't it? How does a giant like Caterpillar deal with these massive pressures, especially tariffs, but still find these, surprising bright spots?
Right. And even offer a slightly better outlook.
Exactly. So we're going to explore that whole complex mix for you, our listener. Let's dive in.
Yeah.
So starting at the top, the headline results for Q2 2025. Adjusted earnings per share came in at $4.72. Now, that actually missed the Zacks consensus estimate. That's the average analyst forecast, basically.
Right.
Missed it by 3.3%. The estimate was $4.88. And year over year, that adjusted EPS down 21%. Pretty significant.
Yeah, and the reported EPS, that includes one-time stuff, was $4.62. That's down 16% from $5.48 last year.
So a clear drop on the bottom line.
Definitely. And the main reasons they point to: lower revenues and higher costs.
And those costs.
Explicitly linked to tariffs.
Yeah.
It's right there in the source material. So you see that direct hit on profit.
Yeah.
It does make you wonder, though.
What's that?
Are the tariffs just, highlighting other issues? Or maybe accelerating them? Or is it really just the trade policy impact we're seeing here?
That's a really good question, something to keep in mind. But then you look at revenue and it gets interesting.
How so?
Well, revenue was $16.57 billion. That actually beat the Zacks estimate of $16.35 billion by about 1.3%.
Okay, so better than expected on the top line.
Right. But it was still down 1% compared to the same quarter last year.
Ah, okay. So beat the forecast, but still shrinking year over year.
Exactly. More than expected, but less than last year. What does that, tell us? Are they maybe sacrificing some price to keep volume up?
Could be. The numbers show unfavorable price realization cost them $414 million. Big number.
Wow.
But that was partly offset by higher sales volume, which added $237 million. And crucially, that volume increase was, and I'm quoting here, mainly driven by increased sales of equipment to end users.
So underlying demand seems okay.
It suggests it was relatively strong, yeah. So for you, the listener, this might show how a big company like Cat sometimes has to, absorb a margin hit short term to hold on to market share when things are uncertain.
Okay, so that's the top line story. Tariffs definitely playing a role. But the real squeeze, like you said, often comes from the cost side. So where did those tariff costs really hit hard? How bad was the impact on profitability?
Yeah, this is where it gets very clear. Cost of sales went up. Pretty significantly, actually. 6.5% year over year.
6.5%. That's quite a jump.
It is. Reached about $10.8 billion. And the sources directly link this to unfavorable manufacturing costs, including the impact of higher tariffs. No ambiguity there.
So that flows right through.
Absolutely. Gross profit dropped 12% to $5.76 billion. And the gross margin took a big hit, down from 39.2% last year to 34.8% this quarter.
Ouch. That really shows the direct line from tariffs to the bottom line.
It really does. A very direct impact.
And were there other cost increases too?
Yep. SG&A expenses, selling, general, and administrative, they were up 2.5% to about $1.69 million.
Okay.
And R&D, research and development, also up by 3% to $551 million.
So costs up across the board, really.
Pretty much. And the overall result, operating profit fell 18% to $2.86 billion.
And the margin?
Operating margin contracted 360 basis points, down to 17.3%.
Okay.
And the adjusted figures tell a similar story. Adjusted operating profit around $2.92 billion, down 22%.
Yeah.
Adjusted operating margin at 17.6% compared to 22.4% a year ago.
So, yeah, the picture is clear. Profitability was definitely under pressure, mainly from those higher costs driven by tariffs.
That's the main story on costs, yes.
Right. So profitability took a hit, tariffs a big driver. But, Caterpillar is huge. It's not just one business. It's got all these different segments, different regions.
Exactly. It's never monolithic.
So to really get the full picture, we need to break it down. Were all the divisions feeling the same pain? Or were there, some bright spots hidden in there?
That's the right question. And regionally, looking overall, it was mostly down. North America revenue dropped 2%, Latin America down 4%, Asia Pacific down 2%.
Mostly down, but you mentioned bright spots earlier. Was there a region that didn't follow that trend?
There was one clear standout region, EAME. That's Europe, Africa, Middle East.
And how did they do?
They actually grew 6% growth.
Wow. Okay, so a totally different story there compared to the Americas and Asia Pacific.
Definitely shows how uneven the global economy is right now.
Okay, so let's get into the actual business segments. Machinery and Energy and Transportation, ME&T. Overall sales dipped 1% to around $15.67 billion.
Right, that's the big umbrella.
Within that, construction industries.
Yeah.
Sales down 7% to $6.19 billion, and the drivers were lower volume and that unfavorable pricing again.
And regionally for construction.
Big drops. North America down 15%, Latin America down a whopping 20%. I mean, it sounds like construction just stalled out in those regions.
Yeah, those are sharp declines.
But then EAME was up 13% in construction and Asia Pacific up 6%. How do you explain that kind of difference? Are we just seeing completely different economic cycles playing out?
It really looks that way. It suggests, maybe higher interest rates or just general uncertainty hit construction demand hard in the Americas. While places like Europe and parts of Asia kept buying equipment. Resource industries, that's mining mostly, also saw sales dip 4% to $3.09 billion. Again, pricing was unfavorable, volumes a bit lower.
Similar regional mix there.
Yeah, pretty mixed. EME in Latin America actually saw increases in resource industries, up 13% and 3%.
Okay.
But Asia Pacific down 10%, North America down 8%. And the operating profit for resource industries took a big hit, down 25% to about $500 million.
So a really complex picture, mixed results everywhere, but you hinted there was a real standout segment. Which one was that?
Yes, the clear winner this quarter was Energy and Transportation, E&T.
Okay. How did they perform?
Really well. Sales were around $7.84 billion. That's up a solid 7% from last year.
7% up. In this environment, what drove that?
It was a mix. Higher sales volumes, favorable currency swings, and better price realization, actually.
Interesting. Which parts of E&T did well?
Power generation was huge, up 28%.
28%.
Yeah. Oil and gas up 2%. Industrial up 1%. Transportation was the weak spot, down 7%. But overall, very strong.
And regionally for E&T?
Also strong. North America sales up 14%, Latin America up 12%. And importantly, the segment's operating profit increased by 4% year over year to $1.59 billion.
So even with everything else going on, E&T found a way to grow both sales and profit.
Exactly. It really shows, how STEE can lean into areas where demand is strong, like power gen in this case, even when other parts of the business are struggling. Strategic strength.
Makes sense. And what about financial products, the financing arm?
Consistent performer there. Total revenues up 4% to just over $1 billion, $1.04 billion. And segment profit was up 9% to $248 million.
So a nice steady contributor.
Yeah, provides some stability amidst the choppiness elsewhere.
Okay, let's shift focus now. Look ahead. One really positive thing they reported was backlog.
Yes, that was notable.
Record sequential growth, they said. Up $2.5 billion in the quarter. Brings the total backlog to $37.5 billion. That sounds pretty good. What does that mean for you, the listener?
It's definitely a strong signal. That backlog is basically locked in future demand. Gives them a clearer path for revenue down the road, even with current headwinds.
Okay. What about cash flow?
Operating cash flow for the first half of 2025 was $4.4 billion. That's down a bit from $5.07 billion in the first half of last year.
Still a lot of cash generation, though.
Oh, yeah. And they returned a good chunk to shareholders, too. About $1.5 billion in dividends and buybacks through Q2.
And their cash on hand.
They ended the quarter with about $5.4 billion in cash and equivalents. That's lower than the $6.9 billion they had at the end of 2024.
Right. Now let's talk outlook. What are they expecting for Q3 and the rest of 2025?
For Q3, they see revenues growing moderately compared to last year.
Okay.
But here's that tariff impact again, very specific.
Yeah.
They expect a $400 to $500 million headwind just in Q3 from tariffs.
$500 million in one quarter, just from tariffs.
Seems like it. And because of that, they expect the Q3 adjusted operating margin to be similar to last year if you ignore tariffs, but lower once you factor them in.
Makes sense. And for the full year 2025?
This is where it gets interesting again. They now expect revenues to be slightly higher compared to 2024.
Wait, slightly higher? I thought they previously said flat.
They did. So this is actually an improvement in their full year revenue outlook despite everything.
Wow. Okay, that's surprising. What about the margins for the full year?
They laid out two scenarios. explicitly because of the tariffs, they estimate the full-year hit from tariffs will be $1.3 to $1.5 billion. Net incremental impact.
Billion with a B.
Yes. So without that impact, they expect the adjusted operating margin to be in the top half of their target range.
Okay, pretty good.
But when you include that billion plus in tariffs, they expect the margin to land in the bottom half of the target range.
So for you, the listener, those tariffs are basically shifting their expected profitability down by a whole tier within their own targets.
Precisely. It really quantifies the massive impact.
Got it. Any word on free cash flow for the year?
Yeah, for the MENT segment, they're expecting free cash flow near the midpoint of their usual target range, which is $5 to $10 billion.
Okay, so let's widen the lens a bit. We've gone deep on SAC. How does this compare to what's happening in the broader manufacturing and construction industry? Is this just a Caterpillar story with the tariffs, or is everyone feeling similar kinds of pressures?
Good question. It helps to look at competitors. Terex, ticker TEX, their Q2 adjusted earnings were down 31% year over year.
Okay, down significantly too.
But, like SAC's revenue, their earnings actually beat the estimates, and Terex's revenues were up 7.6%, also beating estimates. So, again, kind of a mixed bag there.
What's their outlook?
Terex is guiding for 2025 revenue between $5.3 and $5.5 billion, and EPS between $4.70 and $5.10.
Okay, anyone else?
Komatsu, KMTUY, their adjusted EPS was down 8% year over year, but revenues were actually up slightly, 2.3% to $6.3 billion. They're expecting about $27.7 billion in sales for their fiscal 2025.
So also kind of mixed signals from Komatsu.
Yeah. And then there's Manitowoc, MTW. Their results were pending when our sources came out, but analysts were expecting about a 20% drop in EPS, but maybe a small 1.4% rise in revenue, and they have a history of missing earnings estimates.
Right. And just for context, Caterpillar currently has a Zacks rank #3, which means hold.
Exactly. So what this suggests, is that while those tariffs are a huge specific factor for C because of their global scale, the whole sector seems to be navigating a pretty complex environment. You see mixed results everywhere. It's not just one single trend hitting everyone the same way. It's complicated.
Definitely sounds like it. So let's try and wrap this up. Bringing it all together, what we've really seen with Caterpillar today is, well, resilience, I guess.
I think that's fair.
They took a big hit from tariffs, billions of dollars, led to an earnings miss, revenue dip year over year, segment performance was all over the place.
Sure.
But they also showed real strength in places like energy and transportation. That backlog growth is huge. And they even raised their revenue outlook for the year slightly.
It's a fascinating picture. A giant company managing these major external shocks, but still finding ways to pivot and showing, internal strength in key areas.
So the key takeaway.
I think it's how a bellwether company like Caterpillar, when everyone watches for global economic signs, can actually navigate these direct massive hits from something like trade policy. For you, the listener, maybe think about this. How does a company actually absorb billions in extra costs like these tariffs and still manage to project slightly higher revenues for the year? What does that say about their efficiency, their pricing power, or maybe just how strong demand is in certain pockets of the global economy?
It really highlights that constant dance between global policy, corporate strategy, and sometimes the surprising resilience you find when you really dig into the numbers. Always more to uncover.
Subscribe to my channel Report Stock.